Hello, this is Bill Scheid from Applied Finance Research, and in this video we are going to talk about known adverse market conditions for our monthly asset allocation systems and why understanding them is an edge. So first of all, it's important to understand that every system has known adverse market conditions. Understanding them in advance is an edge because when adverse market conditions occur, they don't catch you by surprise and you are more likely to follow your rules instead of abandoning your system. As Dr. Van Tharp always said, the goal is to survive the worst case in the short term to achieve your system's expectancy in the long term. If you don't understand what constitutes adverse market conditions for your system, and you bail out at the bottom of a drawdown, your actual performance is going to be negative regardless of how strong and how good your backtest results looked. So in this video, we are going to discuss three types of known adverse market conditions for our monthly asset allocation systems. The first is grinding down from an all-time high without triggering a sober stop. The second is sideways chop around the system's moving average, and the third is a combination of the above. Now, let's jump into the first condition. So this is grinding down from an all-time high without triggering the sober volatility stop. So on our chart here, what we see is that the system is holding an asset, it gets to an all-time high, and then it grinds down from that high to below the moving average, which is represented by the dotted line here, without triggering a sober exit. So in this moment, the system will ride the market down and take that first loss until the moving average filter kicks in and the system moves to cash. Once the system is in cash, the system would be safely on the sidelines if the market continues lower, like we're seeing here. But also, especially in the case of BMR systems, the system might not move to cash at this point. It might rotate into another holding that displays favorable market conditions. So while this particular asset is going down, the system has rotated into one that is actually going up. So that's condition one, grinding down from an all-time high without triggering the sober stop. Let's look at condition two. So this is sideways choppy conditions around the moving average. So here the market is churning sideways around the moving average and it's producing whipsaws until it breaks decisively in one direction. That's the bad news. Now the good news is, because of the way our systems are designed, if the market breaks to the downside, then our systems will be in cash and protected from further losses. If the market breaks to the upside, then the good news is the system will be positioned to ride the trend. And that is based on the mechanics of the system. However, it only works if you have the discipline to continue following the rules through this sideways whipsaw zone. Now, let's talk about the third condition. This one is the combination of both of the prior conditions. So here, the system would grind down from an all-time high and exit when the moving average filter kicks in. And then the market would recover back above the moving average. So the system would enter, and then the market would be in these sideways choppy conditions, which would produce the whipsaws we saw on the last slide. And this one is definitely the most psychologically challenging of the three that we're looking at here. But again, understanding it in advance makes it much easier to stay disciplined and following the rules. And then remember, the good news is here, the system can either continue to decline and then the market can continue to decline and then your system is safely in cash. Or when the market breaks to the upside, like we saw in a previous slide, then the system catches the upside trend. Now, the bottom line in all of this is, first of all, every system has known adverse market conditions. They are a feature of every system, not a failure. They just come with the territory. If you don't like swimming, don't get wet. And also have a rule to know when your system is no longer working, because then it makes it much easier to continue to follow the rules, and you can identify when the water is too rough, i.e. when the system is performing outside of what we know to be its statistical norms. And then of course we also have rules for what to do when that happens. Second, understanding adverse market conditions in advance reduces the psychological load when they occur, and it makes it much easier for us to stay disciplined and follow the rules. So again, we keep coming back to staying disciplined and following the rules. Why? Because the goal is to survive the worst case in the short term, to achieve your system's expectancy in the long term, and being prepared mentally, psychologically in advance is how you get there. This is Bill Scheid from Applied Finance Research. Thank you very much for watching, and happy investing.